They are lying to you about this current state of the economy. It's going to get much worse before it gets any better, if it ever gets better. So welcome to the Investing in Real Estate show. I'm Clayton Morris. On this show, we aim to make you a more intelligent investor. And boy, this week we saw a lot of fake news. I mean, this week we saw better than expected consumer price index numbers, right? This is the people that were spending money during December, during the holiday season, et cetera, traveling because it's been bottled up, pent up demand. So we saw some better than expected numbers. Wall Street was excited about it. President Biden even went out to the podium and called it the Biden economy. He literally called it the Biden economy. Like, things are so good right now. What he failed to mention, of course, is that the underlying fundamentals, the high debt, the massively high debt that the United States is sitting on, $31.5 trillion, a debt ceiling battle. It's not even about the debt ceiling. It's about the amount of debt that the United States is sitting on, borrowing from China in order to pay Social Security. That's literally what's happening. We're borrowing from China to pay Social Security benefits in the United States. That's the Biden economy that they're so proud of. Food shortages are still happening. Egg prices, still $9, $10 for a dozen of eggs. We're getting reports, I've been hearing from a number of viewers who are telling me how much they're spending for eggs. Certain areas it's $4, some areas it's $5. A lot of areas it's $9 and $10 for a dozen eggs. Are you kidding me? My wife just went to Chipotle. She got a burrito bowl. It was $25. That's inflation. That is a Biden economy that we're so proud of. Higher than expected energy prices, of course, and natural gas and gasoline still and diesel prices. So I wouldn't be out there at the podium praising the fact that we had better than expected CPI numbers, because the fundamentals are still here. Economist Peter Schiff sees the inflation rate continuing to rise, even though we had a slight pullback over the past couple of weeks. He sees it continuing to rise and layoffs continuing. So the recession that began in 2022 unfolding further in 2023. So the Biden administration won't call it a recession, but that's exactly what we're facing. When you have massive layoffs that have been unfolding over the past few weeks, Microsoft, big tech, all sorts of companies announcing thousands of people being laid off. This is not an economy that I would be very proud of. However, there are some positive signs that I want to attune you to right now, which is on the mortgage interest rate side. So we have a pent-up demand for housing, right? The moment that these rates start dropping a little bit, you're going to see bidding wars again. You're going to see a flood of first-time home buyers, millennials rushing out the door once those interest rates drop a little bit. See, these interest rates were keeping some of these millennials and first-time home buyers from making that purchase. Just that 1 point difference or that 2 point difference is the difference between them buying a home or not, or renting and continuing to rent. So once these interest rates come down, and they have now for 4 consecutive months, get ready, folks. Because as we head into the spring and we head into the summer and these interest rates drop even more, because if the government is continuing to funnel money into this problem, then you're going to see interest rates dropping again, and there's going to be a run on housing again because the demand is still there. We need 5 million properties and we just don't have them. So the demand is off the charts. So from a real estate perspective, I'm going to say it again, now might be the best possible time to buy an investment property, especially if it's in that first-time home buyer space. Because holy smokes, not only are you getting, because prices are flat, so you're getting almost sort of like built-in equity. Once these prices start appreciating like crazy, you're getting in that equity piece, which is not how I invest. I'm not really concerned about the appreciation in equity, but you're getting almost like built-in equity once the governor gets pulled off here and things start the floodgates open. But then of course you're also a hedge against this inflation, which we're seeing could even get much worse towards the end of the year. So your US dollar is worth less day after day after day, but having it in real estate is a hedge against that loss and actually goes up in value. So, plus you get the tax benefits of it. So right now, to me, in my mind, this is the perfect time to be investing in real estate. Today is our Q&A episode, so we answer 3 of your questions here on our live show. If you go to our website, go to morrisinvest.com. That's where you can leave us a voicemail message. You can also book a call with our team if you're interested in investing in full-service rental real estate. We are building brand new construction properties built from the ground up, and we take care of everything. Our team is fantastic in the best rental markets in the United States, and we have financing built in. So we were having a meeting last week. We looked at the numbers. Almost every one of our clients uses the bank, uses financing. We work with over 100 different lenders because why would you want to use all of your own money? Use the bank's money. Put a little bit money down, Put some money down, but then you use the bank's money to build your net worth. That's what we do, and it's remarkable. You should do it because that's how everyone does it. That's how the wealthy do it. They use other people's money. All right, let's dive into it. Some questions today. Our first question comes to us from Rob, and I believe Rob is nearing retirement age and really wants to get into real estate investing. Here is Rob.
Clayton, calling about a question. I'm 58. I won't be out of debt for probably 2 more years because of business expenses I got into with a business. I've been doing 20 years power washing, and I want to get into the real estate investing. And my freedom number, all I need is, I'll be happy if I can make $1,000 extra a month. 3,000 a month would be fantastic. And I don't even know where to start in order to be able to get there because of my age. Any advice, Rob?
Thank you, Rob.
Okay, thank you.
You bet, Rob. Thank you so much. Thanks for your hard work and great question. So let's unpack that. So Rob, first of all, mentioned the freedom number, and I want you all to go and download it right now. It's totally free. The freedom number cheat sheet is the thing that changed my life. We've heard from thousands of you that have downloaded it. It's changed your life. Again, it's free. So just go to morrisinvest.com/freedom. We'll have a link in the description of this video and on the podcast. Go grab it, download it, and figure out, it's like 3 pages long. It'll walk you through how to figure out your freedom number. What is the number of cash flow or money you need per month in order to live financially free, where you don't have to worry about anything? For Rob, he said about $1,000. He said 3,000 would be fantastic. I remember when I did my first freedom cheat sheet, I lived in New Jersey. I had 2 kids, 1 on the way. I had a lot of credit card debt. I had bad credit score. I had a lot of expenses living in New Jersey. New Jersey is one of the most expensive states to live in. Property taxes are through the roof. It's just, you know the stories about New Jersey. And so my freedom number, I think at the time, was like $12,000 a month. Like for me to live comfortably. Like if I wanted to live comfortably and be able to have a little bit of padding to be able to take a vacation or whatever, like to pay my mortgage, to provide for my family. Maybe I'm a little higher. Maybe it was about 8,000. I don't know. But it was high. It was much higher than Rob's. My point is that once you do this exercise, when you do the freedom cheat sheet, your eyes will be opened. Holy smokes, wait a minute. I can live comfortably and live the life that I want and not have stress or anxiety for $3,000 a month, because that covers my mortgage, groceries, Netflix, going out to eat once or twice a month or whatever, picking up gas and all of that, and I'm fine. And I've got money left over to send some kids money to the grandkids for their birthday. Wow, game changer. So $3,000 would change his life. That's to me like, 5, 6 rental properties, maybe less, depending on how, financing is structured, et cetera. Most of our rental properties at Morris Invest will cash flow anywhere between, $1,000, $1,100 to $1,500, $3,000 a month. One property could cash flow $3,000 a month, one of our duplexes. Each side of the duplex is $1,500. Each tenant in that duplex is paying $1,500, depending on the duplex. Again, we've got a range of properties. I don't want to be too specific here. So someone gets on the phone with my team and they're like, Clayton said, we have a range of properties. But that's, again, I'm just thinking of one house could hit that number for him. In other cases, it could be 2 single families that hit that number. We can mix and match and figure that out. So that's what our team does. When you book a call with our team, we can look at your current situation, Rob. We can see what debt you're currently dealing with. Are you available for financing? What financing is available for you, given your work, your W-2 employee? Are you self-employed? How does that look? We can talk through all of that. But I would start. You said I don't know where to start. Rob, I think the first thing to do, number one, you can book a call with our team and we can help you there. The other thing to do is we have a whole video series on our YouTube channel, and it's a beginner's masterclass in real estate. And we take you through video 1, 2, 3, 4, 5, and we walk you through the entire process, where to start, how to get going with all of this. So I would encourage you to watch those videos. And then if you need the extra help, please book a call with our team and we can take you from there. Don't worry about the age piece of this. We've had real estate investors who started in their 70s. We just got to look at the different pieces you have available. Do you have a 401k? Do you have an IRA? Do you have some cash on hand? What is the debt that you're trying to pay off? Do you need to put all of your money to paying down that debt that you talked about, or can we split it up? use some of it as a down payment. So all of these things we need to be creative with, Rob. So thank you for your question and good luck to you. We'll talk soon. Judy has a question.
Hi, Clayton. My name is Judy, and I am from Los Angeles, California. I am in the middle of purchasing my first investment property through your company, Morse Invest and Sedera Wealth. And I'm purchasing a half a duplex in Dwinweg, Missouri. I guess based on my individual circumstance, I guess one door made the most sense to me right now. But my question is, I was wondering how long I have to wait before I can buy or purchase another property through your company, and if non-recourse financing would be available to me. Thank you.
Well, thank you, Judy. So non-recourse financing is, of course, financing that's not tied to Judy personally, but to the asset itself. And the properties where we build are in some of the best areas in the United States that we've identified and been, we map these out years ahead of time so that we know the demographics, the demand is off the charts. Where she just mentioned in Missouri, there is nothing available in this area for rent. And so when we've been building there, they're rented up like that because the demand is off the charts. Having said that, the banks will look at those assets and say, wow, these are in the best school districts. The demand is off the charts. We know that this will cash flow a certain amount. So we're going to finance the asset itself, not Judy. So non-recourse financing typically has a higher interest rate, but we've been able to negotiate with the banks we work with to keep those interest rates comparable to what the regular traditional mortgage interest rates are. If you go off and do it on your own, you're going to pay usually a lot more for non-recourse financing. But we build 500 homes a year and we work with the bank, so we're able to negotiate those things a little differently. So non-recourse financing really comes down to your situation, Judy. I would just say talk with our team member, whoever on your team you're working with at Morris Invest. Just have this conversation with them. They're going to know your finances better than I will just through a phone call here. But non-recourse financing is always available. It's always an option. You might be wondering why or how quickly you can acquire another rental property. There shouldn't be any limit to you being able to acquire a property very, very quickly. You buy one. We have clients all the time who are adding properties on a semi-monthly basis. All the time. We have many of our clients at Morris Invest are buying multiple properties per year, and they do it on a regular cycle that they add to their portfolio. So it really comes down to a limit on financing really, and what your current situation is, because maybe you own 10 properties already. And then you're at that traditional level where you're not able to go beyond 10 under the federal guidelines under a traditional mortgage. So you're having to think about non-recourse for your 11th and 12th property. We have a lot of clients that do that. They have 10 properties using traditional financing, and the United States law, you can't acquire more using that process. So you have to go with non-recourse or some other kind of funding. So maybe that's you. I don't know from your phone call if that's your situation. But if you only have one investment property, then no, you won't be at that federal limit. So traditional financing might be still available to you. So those are all questions I would just ask your portfolio manager on the phone and can guide you. But there should not be a speed problem with you acquiring another property. I guess it really just comes down to your personal finances and your availability of financing. So thank you for that. Our next question comes to us from Esther.
Hi, Clayton. How is the rental property depreciation can be calculated and applied in the SDIRA account? Thank you.
So thank you, Esther. So while an SDIRA, a self-directed IRA, is one of my favorite wealth building vehicles, because when you buy a rental property inside of it, the cash flow from the tenant grows tax free, right? And then when you're at retirement age, you're able to take that money out and not pay taxes on it. It's a brilliant way to grow wealth, right? It's a great way to take an old IRA or an old 401k that's been sitting there and convert it to a self-directed account, get it out of the stock market, and buy real estate. You can also use it in part to buy as a down payment and then have financing the rest of the property, right? There's all sorts of great ways to use a self-directed IRA. However, you cannot claim depreciation in a self-directed IRA. Cannot do it. So in a self-directed IRA, depreciation, of course, is one of the main benefits that you get from investing in cash flowing rental properties. But when you buy the property inside of a federal self-directed IRA account, you cannot then go to your taxes and claim depreciation. The reason being is because you're getting all of that cash flow tax-free. So you can't get the cash flow tax-free and then also claim tax benefits on the property. They don't allow that. So that is one downside of this. But the upside, of course, is you're getting the cash flow from the tenants tax-free. Anyway, just think about it, for instance. So let's just say you make $100,000 in cash flow from your properties. Because of depreciation, then you won't pay a penny of taxes on that amount because you're claiming depreciation, right? So this is equivalent to making $125,000 of W-2 income if you're assuming about a 25% effective tax rate, okay? Maybe even higher depending on your tax rate. If you're a real estate professional, it might be a little lower. But again, that would be about $125,000, right? Well, the same thing is true if you have the cash inside of your account, inside of a self-directed account. You're getting that cash flow tax-free. So in a roundabout way, it kind of works out to be the same thing, if that makes sense. Short answer is you can't do it, Esther. Sorry. Inside of a self-directed account, you cannot claim depreciation, but you get all the other benefits of owning it inside of a self-directed account. So hope that answers your question. Thank you so much for this. Thank you all for your great questions. You can go to our website, morrisinvest.com, click on the microphone icon, which is on the right-hand side of your screen. Leave me a voicemail question, and we will try to answer your questions here on the show. Now go out there, take action, become a real estate investor. I believe it's the number one way to build and preserve your wealth. We'll see you next time.